Good day and welcome to Gemfields full year 30th of June 2015 conference call. At this time, I would like to turn the conference over to Ian Harebottle, Chief Executive Officer. Please go ahead.
Super. Thank you very much. I just want to say good morning to all of you. Thank you to all of you attending in person. Much appreciated. Thank you to Reed Smith for giving us the use of your facility. We always appreciate that. Thank you very much. And everyone dialing in as well. Thank you. It's great. Joining me from the company side today, it will be myself, Ian Harebottle, the CEO. Dave Shetty, our Chief Operating Officer, is calling in from Colombia. And Janet Boyce, our CFO. We're all joining together. So without further ado, we will then turn over, we'll skip through the disclaimer, and we'll go straight on to slide 3, Gemfields at a glance. I think this is a good time for me as well to really thank my team. I think within Gemfields, I have the privilege of working with an exceptional team that continues to deliver year upon year upon year. When one is a relatively small company starting in a new sector where you really have to build the skills, the knowledge, the competence, that's not always easy. But I think the importance and the energy and the effort of our team is reflected in the numbers. Just to summarize Gemfields over the last 6 years, some of you have been involved for the whole period of time, some of you have come in later, but the growth and the trajectory of our company has been phenomenal, to say the least. Over the last 6 years, our revenue has gone from 0 to just short of 200 million. Our share price has gone from 2 pence to just short of 60 pence. Our market cap from around 9 million to around about $500 million. So that's an incredible trajectory. But I think of all of that, the year where we've shown the most growth has been the last year. The amount of growth within the company over this year was really incredible. And I think that bodes very well for the future, for the business as well. Just to summarize what some of those areas are, the company now has 2 fully operating mines, both Kagem and Montepuez. Both of them are producing, both of them are revenue generating, and both of them are actually profitable. Both of them are full tax paying. Within the resource sector as a whole, but specifically within the resource sector in the jurisdictions where we operate, that is quite unique at the moment, where you have companies that are really producing revenue, paying, building skills, jobs, tax, etc., and paying taxes, and that's very important. Over and above that, we brought the market 2 resource statements. One was a brand new one for Montepuez, and the other one was an update for Kagem. An incredible amount of work. The scrutiny and integrity of those resource statements, maybe within the resource sector as a whole, it gets lost, but within the gemstone and color gemstone sector specifically, incredible. The fact that a very small percentage of Montepuez can generate such potential future growth is amazing. And again for Kagem, the fact that we were able to deliver a proven resource. To my knowledge, that is the first proven resource ever within the colored stone sector. That is indicative of how Gemfields is not only growing its business, but growing the sector and transforming what I think is a huge opportunity, but for a long time has been forgotten. Over and above that, one of our little businesses, and I'm hoping some of my team are listening in, it is the one that we tend to overlook, and I have to apologize, but it's our Kariba amethyst mine. Kariba, for many years, has been washing its own hands. It's still a high volume, relatively low value. I've always believed the potential for Kariba is incredible. A beautiful stone will wholesale at about $30 a carat. There's no reason why those magnificent gems shouldn't be wholesaling at $300 a carat. It just takes time and energy and repositioning. And when we get there, that'll be a very profitable mine. But I'm pleased to say, over the last year, that mine has not only held its own, but starting to add to the bottom line numbers, which is great. So thank you, Cyril. And then, of course, the additional issues that are, or the opportunities that are covered within our current portfolio, which is another 300 square kilometers of mining license in Mozambique, Sri Lanka, a trading operation plus exploration licenses, Ethiopia, 400 square kilometers of exploration. I was last in Ethiopia I think it was 2.5 years ago, one of my team just came back and he said, Ian, you have to come back. Not only our project alone, but the country, the rate of growth of the mining sector and how it's matured. There was a mining conference. He says it's really encouraging. So I'm so glad that we were part of the beginning, and I look forward to doing much more. And then Colombia, as I said, Dev is there at the moment, and Colombia is important. So those are key. And then, of course, Fabergé. Fabergé, we acquired Fabergé with a specific vision to drive change and position colored stones at the highest end of the luxury segment. And over the last year, we've worked extremely hard, bringing on 4 new watch offerings. One men's complication, a ladies complication, a ladies core watch, and a ladies high jewelry. 2 of those are up with potential to win awards as watch of the year in their segments. That's unheard of within such a short period of time to bring something of such quality to the market. And that's shown in the fact that we've increased our wholesale distribution partners by 30% over the year under review, and in fact further afterwards. Obviously, all of these things take a little bit of time to kick right through to bottom line, but one should never overlook the core drivers and the core factors. And then again, finally, something that's very important, again, I tend to overlook because I take it so for granted within our business, but one should never do that because it's critically important to the core values of Gemfields and our sector as a whole, and that's what we've managed to achieve from sustainability. Our continued efforts to building schools and clinics and farming projects, the continued input into the environments where we operate, and more importantly, the incredible safety track record that our team is able to continue to sustain at both of our mining operations. It's unreal. Cargem has once again had a flawless year with 0 reportable injuries. At Montepuez, I think there were 3 or 4 during the year. It's a very small, but they were all minor injuries, and it's indicative of a small mine that's just beginning to build its footprint. But it's an incredible track record. I'm very proud of that. And I think that really takes me to the essence of the slide that we're on at the moment, Gemfields at a glance. I firmly believe that Gemfields is a champion in coloured stones and the world's single largest coloured gemstone mining and marketing company, a position we're very proud of, and we certainly will continue to do everything in our power to sustain and maintain. I've just mentioned the successes we've had over the last few years, and then the question has to be how confident are that we can sustain this trajectory, and I, for one, am very confident, and I can base that on 2 key elements. It's the assets within our company. And the most important one is the soft assets. It's the people. It's the skills. In Gemfields, right now, we are busy developing, and we currently have the world's leading coloured gemstone exploration geologists, mining engineers, processing engineers, distribution, marketing, etc. That is an incredible place to be, and that you can see is actually kicking back into the growth and the potential we're building in the business. And then our hard assets. The world's single largest producing emerald mine, producing as much as 30% of the world's supply. The world's single largest ruby mine, producing as much as 40% of the world's ruby supply. The world's single largest amethyst mine, producing as much as 40% of the world's amethyst supply, Fabergé, and many, many more. That is a great foundation that we can build the business, and supported by a company and a team that I believe likes to treat every penny as if it's their own. I do like to believe, despite the fact, and we'll discuss that slightly, even though our costs have grown, the costs have grown minuscule compared to the footprint, the actual scale and future potential of the business, and we manage every penny as if it's our own. We are not a company that is spending shareholders' money. We are not a company that is spending someone else's money. We're a company that treats every penny as if it's ours and spend it accordingly. In other words, wisely, specifically targeted with a clear objective of delivering growth and value for our shareholders. So we now go to slide number 5, which is the highlights, and then I'm going to hand over to Janet. And those are pleasing numbers. Sometimes, and I've had a few discussions with some various people in the market today, and it's amazing because when you continue to look at Gemfields results, record revenues, record per carat prices, record production, sometimes that becomes kind of overlooked, and one just thinks it's a normal, and you can almost still be disappointed, which is crazy. But I think these are very, very stable numbers, very solid, and as I say, I'm very proud of them. 171 million revenue, which is the highest revenue we've achieved to date, an increase of 7%. I noticed somebody got that all wrong and said it was a decrease. I don't know how they saw that number, but certainly our numbers increased very pleasingly. Our EBITDA was up 9% to 64 million, a gross profit of 50%. And what you have to bear in mind with all of that is, as I say, that's taking into account a company that is focused on growth. That's including the additional commitment on marketing, exploration, and growth, which is all embedded in those numbers. And then inventory of 100 million, which has increased from 86, and cash on hand of 30 million by the end of the financial year. So a very under-geared, very strong business with a very positive future. Janet, I'll hand over to you.
Thank you very much, Ian. So if we go to slide 6, so this shows us the consolidated income statement for the year ended 30 June 2015. And as Ian mentioned, our revenue increased by 7% from $160 million to $171 million, whilst maintaining a gross profit margin of about 50%, or a gross profit of $85 million. Our selling, general, and administrative expenses have increased during the year, and I would explain the reasons for this in a later slide. The finance costs also increased during the year. As we've always been saying in our previous communications to the market, we feel that the company is highly under-geared. And during the current financial year, we've successfully increased the facilities available for the company. In the previous year, the outstanding debt balance was around $17 million. In the current year, it has increased to about $45 million. And that contributed to the increase in the finance expenses. Also included in the finance costs are foreign exchange differences, particularly relating to your Mozambican Meticash and your Zambian Kwacha. The profit before tax was around $26 million with a tax charge of $14 million, giving us a profit after tax of $12 million. During the current financial year, there's a number of changes in the tax and the mining regime, particularly in Mozambique and Zambia. More notably in Zambia, whereby a 20% royalty tax rate and a 0% corporate income tax rate became effective on the 1st of January 2015. Since then, a new tax law has been passed, effective the 1st of July 2015, whereby a 30% corporate income tax plus a variable corporate income tax rate of up to 15% became effective on the 1st of July 2015. Alongside that, the royalty tax rates also were changed from 20% to 9% based on revenues. These changes in the tax regime in Zambia would see an overall increase in the taxes payable for Kagem in the foreseeable future, being a higher profit margin business. During the current financial year, we held 6 auctions, 3 of emeralds and 3 of rubies, generating total revenue of $153 million. Compared to the prior year, we've got a different mix of auctions held in the current year. In the prior year, we did 3 auctions of emeralds, 2 of high and 1 of low quality auctions. And we also held 2 traded goods auctions in the prior year, which we didn't do in the current financial year. Without question, our Mozambican rubies, our Montepuez ruby mine, delivered excellent results during the current financial year. Although it's still very early days, the response from the market for our Mozambican rubies has indeed been very positive. In our December 2014 auction, we achieved an average price per carat of $689, which is the highest price ever recorded in any Gemfields auction to date. Our Zambian emeralds also continue to enjoy firm demand and has been highly sought after in the international market, underpinned by increases in the prices achieved for both higher and lower quality auctions. In our November 2014 auction for higher quality emeralds, we achieved an average price per carat of $65.89. And in our February 2015 auction, we achieved an average price per carat of $3.72, which is the highest achieved for that quality emerald. Our inventory balance at the end of June 2015 increased from $86 million to $101 million. And this excludes your fuel, your spares, and other consumables. The $101 million of inventory includes your Fabergé inventory of $36 million and $65 million of rough cut and polished gemstone. Your $65 million of rough cut and polished gemstones include $41 million of rough emerald and beryl, $9 million of traded goods, around $9 million relating to your cut and polish inventory, and the remaining $6 million relating to the rough ruby and corundum. The total cost of sales during the year was $86.5 million compared to $75 million in the prior year. And your cost of sales is composed of your mining and production costs, which during the year was around $46 million, your change in inventory of $6 million, and your depreciation and amortization of $34 million. The depreciation and amortization increased from $22 million in the previous year to $34 million in the current year, primarily due to the increase in the ore mined. In particular, in Kagem, in the prior year, we mined a total 80,000 tons of ore compared to 124,000 tons of ore in the current year. And this increase in the ore mined drives the increase in the amortization of your mining asset and the deferred stripping cost. Furthermore, the investment in capital expenditures in your mining assets, in your equipment and infrastructure also drive the increase in the depreciation of the PPE. We have seen an overall increase in the scale of operations both at Kagem and MRM, and this has driven the increase in the mining and production costs during the year from $27 million to $46.5 million. It's worth noting that during the current financial year, we have seen a number of changes in the royalty tax rates as well as production taxes. In Zambia, for our Kagem mine, for the first 6 months of the financial year, the revenues were charged 6% royalty tax, while on the second 6 months of the financial year, we've been charged 20% royalty tax rate. For Montepuez, we've been charged production tax of 10% during the first 6 months of the financial year, and this has been decreased to 6% from January 2015 onwards. So apart from mineral royalties and production tax, which are driven by revenues, the three other main items of mining production costs are your labor costs of $13 million, your fuel cost of $6 million, and your repairs and maintenance of $4 million. And these three items account for approximately 50% of the total mining and production costs. And if you include the mineral royalties and production taxes, that accounts for around 78% of the total mining and production costs. The rest of your costs include your security, your camp costs, your blasting, and other processing expenses. It has been a record year for our cornerstone business for Zambian emeralds, having achieved a 49% increase in production during the current financial year to 13 million carats. And I'm proud to say this is the second highest annual production achieved since we've acquired the business in 2008. The increase in production is in part due to improved volumes of ore as a result of the increase in the ore mine in the Chama pit operation, but also supplemented to a certain extent by the bulk sampling operations in Fibolele and Lipuente. We've also employed better rain management at the mine during the rainy season, which also contributed to the increase in the production. I'm also pleased to say that the fourth highwall pushback program, which started in May 2014, progressed well during the year and completed in September 2015. This would provide ore production for at least the next 2 years for Chama pit operation. The total operating cost for Kagem increased from $32 million to $44.5 million, mainly driven by the increase in the scale of operations as well as the acceleration of the bulk sampling operations at Fibolele and Lipuente. Our total rock handling increased from 7.4 million tons to 15 million tons during the year. Our cost per carat decreased from $1.58 to $1.48, mainly due to the production increase. And furthermore, our cash rock handling cost decreased from $3.70 per ton to $2.90 per ton as a result of efficiencies and economies of scale. With regards to Montepuez, the total annual production is 8.4 million carats with a grade of 26 carats per ton, compared to 6.5 million carats with a grade of 41 carats per ton. the 8.4 million carats of production, around 7.4 million carats were derived from your Maninganais secondary ore deposit. Around 700,000 carats were derived from your primary ore deposit in Maninganais, and 200,000 carats from your Mugloto secondary ore deposit. The decrease in the grade in the current year is a direct result of the focus of the mining and processing in the secondary ore deposits, which are lower grade but higher value goods compared to the primary ore deposit. The total rock handling during the year also increased from 1.6 million tons to 3 million tons. And as a result of the discovery of the higher value goods in the secondary ore deposits, a significant portion of the mining happened in the Mugloto area. Around 74% of the total rock excavated were done in Mugloto, and the rest was done in Maninganais and other pits. It's also worth noting that at the beginning of the financial year, there has been a change in the accounting treatment of our Ruby project. In our prior year, we've treated the Ruby project as an exploration asset, and in accordance with accounting standards, relevant costs were capitalized in the balance sheet. So post our June 2014 auction, where we've provided evidence of the economic viability of the project, we've reclassified the asset into a development production asset, and therefore all the relevant costs are now being expensed or recognized directly in the income statement. So this change in accounting treatment, the increase in the total rock handling, and the focus in Mugloto area all contributed to the increase in the operating cost at Montepuez from $7 million to $22 million. The total ruby and corundum extracted to date is 16.8 million carats, of which 5.9 million carats have been sold to date. Our selling, general, and administrative expenses was $55 million compared to $48 million in the prior year. The three main items composing this is the labor cost of $21 million, selling, marketing, advertising expenses of $16 million, and your professional consultancy fees of $6 million. Three items account for at least or approximately 77% of the total SG&A. The rest relate to your travel, your rent, your insurance costs, your IT, and other office-related expenses. During the current financial year, you've seen our business has grown from the previous year, and the number of jurisdictions where we operate in also increased. And as a result, the labor costs not only in the mining, but also from administrative, head office, and support staff have also increased. We maintain our commitment to the sector by investing in the development through marketing, exploration, and M&A activities for long-term value creation. And during the year, we've held a number of marketing activities, including those events focused on promoting Mozambican rubies. Fabergé also successfully participated in a number of trade shows, including your Doha, your Basel World Masterpiece event in London. We've also launched a number of new products, including your new timepiece collections and Imperial class objets. Furthermore, during the current financial year, we've successfully, as Ian mentioned, successfully completed a number of acquisitions of prospecting and exploration assets in Ethiopia, in Mozambique, in Sri Lanka, and more recently in Colombia. And these have contributed to the increase in your legal expenses, your due diligence expenses, professional and other professional fees. Finally, despite all the increases in the operating expenditures, we maintained the upward trend for our EBITDA, which we maintain at 38% margin, increased by 9% from $59 million to $64 million in the current financial year.
Super. Thank you. With that, we're going to hand over to Dev, and Dev is just going to run us through the operational highlights for Kagem and Montepuez.
Thank you, Ian. Thank you, Janet. I'll start with the slide 14. In the financial year 2014 and 15, Kagem ended with 30.1 million carats of total production, with an average grade of 242 carat per ton, which is roughly around 49% more than what we achieved in the last financial year. Quite an encouraging result we also have got from the bulk sampling pit, especially from the Fibulele bulk sampling operation, where we achieved around 2.3 million carats. The safety records for Kagem continues to be the best ever, where we achieved 3.5 million injury-free shift. Focusing on the coming financial year, the outlook, we are targeting around 25 to 30 million carats, with a total rock handling of 14.5 million tons, of which 11 million tons would be from Chama, and the rest from the bulk sampling side. While we will continue focusing on Chama operation, the focus would also be to develop further the Fibulele bulk sampling operation, and also expanding the Libente bulk sampling operation. We are also we have also just started the exploration program in the Sandwana area, which is right at the north of the Fibulele operations. It's an expansion of Fibulele operation, and also there is a potential to increase the processing capacity to 180,000 tons by 2018. That is from the wash plan. Moving to the next slide number 15. In September, we also released Kajam Jok resource and the reserve update, which came with a very encouraging results with around 25 years of open pit life, 25 years open pit life of mine for Chama, and with Fibulele roughly around 7 years. I'd like to stress here that the Fibulele 7 years is restricted now, but once we come with the complete life of large-scale mining plan, we would come to the market and update the further resource for Fibulele. Chama operation, which currently operates at 900 meters strike length, there is a potential that we can even expand that to around 1.5 kilometers. The total resource that was reported in the JOC resource statement was around 1.8 billion carats, of which around 290 million carats was under the measured category. Just to put into perspective, the measured category, it equates to roughly around 7 years of life of mining, which, as Ian mentioned before, is one of the best things to happen, is to get the measured category for Kajam operation. Then, in terms of the potential expansion plan, taking everything into consideration, there is a potential to expand the total carat by 50% to 45 million carats, which would roughly give around discounted NPV of around $520 million. Moving to slide number 16, Montepoet operation. The total carats that we produced in Montepoet was around 8.4 million carats of ruby and corundum, with an average grade of 26 carat per ton, which was roughly around 29% more than what we did in the previous financial year. In terms of the outlook, we plan to target around 8 million carats of rubies and corundum the next financial year, with around 3 ruby auctions that we are planning in the coming financial year. The total rock handling is planned around 3.3 million tons, with the potential. We also have a potential to further increase the mining capacity to 5.6 million tons, with an annualized rate, wash rate increase to around 1.3 million tons. The further expansion plan that we have with the increase is roughly around 20 million carats by 2018. Moving to the slide 17, we also released in the last quarter a JOC resource and the reserve for Montepoet Ruby mine. The resource, which was covered only for the 10% of the license area, it gave 21 years of life of mine, with roughly around 432 million carats to be produced over the life of mine. The total indicated and the inferred resource came around 467 million carats, with a grade of 62 carat per ton, and gave a discounted NPV of around just around $1 billion. What we are also planning to do is to expand the exploration program beyond what SRK has reported, and the early indicators are looking quite encouraging. Moving to the slide 18, which starting with Colombia, we announced the 2 acquisitions in Colombia. The first being the Cosquez Emerald Mine, which is a producing mine. It has got more than 20 years of history of large-scale mining, and that acquisition is subject to completion, which we expect should get over by in next 6 months. We also announced a bunch of exploration licenses, around 8 licenses, which we acquired from ISAM, which is a Spanish conglomerate. What we have also done, since we have put the project team in place, so as we speak, the project manager has already been appointed, and there is also the core management team which has been appointed. Now, in terms of what we are planning to do, is it is going to take at least 18 to 24 months for us to come to the market with a complete plan for Colombia. Moving to Ethiopia, as Ian said, Ethiopia looks quite encouraging. We have started the initial exploration phase, the mapping and the pitting and the trenching, and we have put a management team in place, and mainly geologists. Sri Lanka, we have commenced the trading operation. The initial setup has been done, and the trading manager has also been appointed, and we plan to start the trading operation very soon. Kariba, as we reported in the last auction, Kariba, we have now started selling the high quality amethyst through our auction platform, and we would continue to do so in the coming years also. Now, we also acquired 2 additional licenses in Mozambique, which Ian mentioned earlier. In Madagascar, most of the licenses have been kept in care and maintenance, but we still hold around 20 exploration licenses. I would hand over to Ian first from slide number 19.
Excellent, super. Thank you very much, Dev, for that input. So on to Fabergé. As I mentioned earlier, our initial target behind acquiring Fabergé in 2013 was very specific to drive the use and the aspiration for colored gemstones at the very highest echelons. Our intention was never to compete with our downstream customers. Now, who are Gemfields customers? It's really everybody out there. So it's from the TV channels to the, if I can say, the Walmarts and the superstores of the world, to the mom and pop stores, the high street, and the very high end. Fabergé was really just to drive change and to showcase that there is really potential for all of those sectors to increase margin, demand, etc., through the use of colored stones. I'm very pleased to say that objective we have achieved. We could almost tick that off straight away. And you don't have to take my word for it. Walk down any of the high streets, go to any of the supermarkets, etc., and the malls, and walk into a jewelry store, and you will see a significant increase in the use of colored gems. So that's been done. Certainly, when we acquired Fabergé, our indication to the market was we were expecting it to be profitable in 2 to 3 years. We've now had it for 2 years already. But at that stage, our target was on initially a couple of retargeted stores in a few locations. I'm very pleased to say, as we've worked with Fabergé and the market, my personal and as a company as well, the potential we see for Fabergé has gone way beyond. And that's meant we've invested a little bit into added research and development. For the watches, as I say, all of you, I would encourage you to pop into the stores and have a look at the watches. It is world-class product, up there with the best in the world. Certainly, you know, it bears testament to the slogan of our watch product: "Is our heritage is your legacy." You can feel it when you touch it and when you wear the product. That is working well. We've also changed our design so that together with that, slightly more core and entry, so there's an easier entry into the Fabergé brand. That's worked very well. I'll give you a small example. Purely by chance, somebody that knows one of my staff happened to have a bunch of Chinese friends that were visiting London just recently, and they said, can they pop in to the Gemfields offices? And I said, sure, we'll take them around. And I think we did about 8 sales by the time they left out. They loved the product, and that wasn't targeted, it wasn't marketed, it was pure coincidental, someone walking through your office and seeing your product and absolutely falling in love with it. And that's just one small example. We've then also relaunched the Fabergé Objets. That's your imperial class product, which is not just the eggs. Fabergé is well known and recognized for the eggs, but it goes beyond into various pieces of jewelry almost on display. So whether it's picture frames, etc., we're working with that. And again, another great anecdote was the Fabergé pearl egg. We put a lot of energy and a lot of effort into, and we took a slight amount of risk into developing this product. We launched it at Doha, and literally within less than an hour of launching, it was sold, which is great. We were very pleased it was sold. It went for a very pleasing price. But what was very important to me was about 4 months later, I met the person who had bought it, and he came up to me and he said, "Ian, thank you for selling me. Thank you for giving me the chance." Now that is, wow. I wanted to say thank him for buying it, for giving us a nice price, etc. But it's indicative of how meaningful it was and how much it's appreciated. So with that in mind, and that has not just been recognized by ourselves, certainly by the downstream market, and as I said earlier, the number of wholesale outlets has increased by 33%, or we've got 4 company-owned stores, and it's actually more now as we talk, but by the end of the calendar year, it had gone from 16 to 20. So that means a bigger distribution footprint around the world with other very successful retailers that see the value of having your product, your brand in their store, multi-brand retailers, as we all know. So I'm continue to be happy with Fabergé's projected trajectory. We again are very sure that it will be standing on its own, profitable within 2 to 3 years, but a much bigger footprint now, and it continues to deliver and drive change within the group and demand for colour, and its costs are very under well control. So I really want to thank. That's one of the divisions, not so much internally, but certainly in the market, that takes a little bit of hammering, because Gemfields will come with record revenues, record sales, record per carat prices, and generally the coverage is well done, and a little bit of a different line goes for Fabergé, and it's tough. We have an incredible team, a lot of energy and a lot of work, and I personally want to thank them for their effort, because it's absolutely incredible. And then just finally, where we're going forward. So looking forward and the growth opportunities, I think everything we've covered to date gives you a very clear indication that it's certainly our operating footprint has massive future potential. Kagem has potential to increase its production from 25 to 30 million carats right up to 45 million carats. Montepuez has potential to go from its current around 8 million carats up to as much as 20. Then, of course, you add your Colombia, your Ethiopia, etc. Plus the fact we've opened 3 trading offices, so Sri Lanka, Zambia, plus Mozambique, where we can access, and this is a very important component, where we're actually able to access rough from other small-scale miners mining in our region. That's important for various reasons. As a miner ourselves, we understand the importance of a miner getting fair value for his goods. Generally, a trader is very focused on buying the goods as cheaply as possible and selling them as high. He wants to make the margin. We want to make sure our fellow miners get fair value for their goods as part of our sustainability. It also allows us to ensure that a greater portion of the product coming from our regions goes in an ethical way to market, etc., etc. So, and marketing, we've been very successful. Our Gemfields inside, the division that sells cut and polished, it's our customers' goods. We sell the rough. We then get access to a small percentage of our customers' goods, and we're able to distribute that to young and up-and-coming designers who don't have the finance to buy large volumes, etc. But some of the big brands, and a few of the co-marketing, co-branding joint projects we've done. Pomalata will be one, George Jensen's another one, and so on. There's many, Amrapali and so on. That's very, very pleasing, and that's growing extremely well. I just want to quickly close with a market overview, and then I'm going to hand over for questions. But the next question, while we've spoken about the resources in the team and the resources in the ground, the one question that always comes, and I'm sure when we go to questions and answers, is, Ian, if you look at global markets, there's a slight softening, while America and England seems to be growing, some of the others perhaps not so. How confident are you? And we've always, as Gemfields, tried to be as cautious as possible. We like to under-promise, over-deliver, but we've always been quietly confident that the demand for coloured stones will continue to increase over the coming years, and I believe that is still very much the case. And that marketing overview slide just gives you some indication. So global import of finished, so work-coloured gemstone products, so that's the whole, and pearls increased from 6.8 billion in 2013 to about 8.6, so a nice healthy increase. Of that, the component, which was emeralds, rubies, and sapphires, went from 5% to 11%, so a nice healthy growth, which means that your emerald, ruby, and sapphire component is about 5 billion of market, where it went from 3.8 billion just the year before. And that's true in various ways. If you look on that slide, some of the indication of the graphs on the side, you'll see that premium ruby still continues to enjoy a very, very healthy demand, and it can attain very pleasing prices per carat. But if you look, we've shown two graphs, your D diamonds and then your F, so your more commercial goods and your higher end goods. If you look below that, your rubies, your sapphires, your emeralds on large are selling at a significant discount to diamonds, which is great. It's fantastic, you know. The diamond industry has done a very good job of driving demand. The colored stone industry not so much. With increased production, increased distribution, and increased marketing support, we have every level of confidence we can lift that, which means there's value in each one of our products. So I don't want to spend too much time. Before I hand over for questions, again, just want to thank everybody for attending. I want to thank all of you dialed in. And then some of those that just kind of we forget to thank, I must say I do, is our service providers. I did thank Reed Smith early on, but Tavistock, you guys continue to do an excellent job. The presentation you helped us was fantastic. And our brokers, JPM, Macquarie, and BMO, thank you very much for your work. I think you can see in the presentation and the results and everything else that Gemfields is certainly growing up as a business. I was saying to someone earlier, you know, just till recently, we were a very energetic, very enthusiastic teenager. I believe as a company now, we're a young adult that I certainly am proud of, and we look onwards and upwards. So with that, I'm going to open to questions on the floor. Afterwards, I think we'll do the phone, Emily, and then after that, we'll do...
If you'd like to ask a question over the telephone, please press *1. That's *1.
Okay, Ian, is there any chance you can give us some indication of when KGEM's going to start to get towards the reserve grade? Because obviously you're mining well below that, and there's a significant opportunity there.
Yeah, well, I mean, that reserve grade, the grade that we're mining at the moment is a blended grade between the pits. And, you know, because we have a single processing plant, when you're putting through your bulk sampling together with your main production, there's obviously some level of dilution, so that impacts on it. The other thing, and I think you'll see when we put our next quarterly report out, the mine continues to produce very pleasingly, but a grade is a 12-year period. Generally, KGEM has been very consistent on a 12-year rolling average, 12 months rolling average. It gives a very constant, you know, around about 300 carats per ton, but it does fluctuate on a month-to-month basis. So that all depends on what period you're actually taking in the slither. But as I said, the bulk sampling does dilute it to some extent at the moment, and that will continue for some level of time because we are still bulk sampling 2 additional pits. So, but as long as we can keep the costs down, the overall blended grade, I think, is very pleasing at the moment, and it can only go upwards. Deb, I don't know if you wanted to add more on that question.
No, I think you have said it.
Okay.
Okay, and then looking at the inventory with new product lines from Fabergé, we haven't seen the inventory move that much there. Is there some kind of growth of that to come?
Yeah, but not massively so. So again, not massively so. I think we're being more selective. We inherited Fabergé with a specific inventory in store at the moment. We've managed to sell it out. We have a very clear positioning with Fabergé, focusing very much on emeralds, rubies, and sapphires and other high-quality product. So we've actually managed to move some of the inherited inventory and bring in some of the, if I can say, the new Fabergé. And then, of course, a lot of the additional growth is coming through wholesale sales stores, which is not your own inventory. So there will be some growth, but I'll be certainly not targeting a massive increase. Also, remember your Fabergé inventory is at cost of inventory, and as we continue to be more efficient and more streamlined and more focused, we're able to improve our margins and reduce our cross-through efficiency as well. So you might have more product, but it doesn't necessarily show straight through to increase in value.
As a reminder, to ask a question over the telephone, please press *1.
On your ability or the trade-off between funding internally via cash flow or potentially increasing debt to fund that. And also what do you see as the critical path for the expansion at that project? And then secondly, just on Fabergé, which you did touch on, it continued to be loss-making, and obviously needs further investment for the turnaround there. Internally, how do you think about that required investment, particularly when it is competing for capital against the likes of Kagem and Montepuez?
Okay. I'm actually going to start with the second one first. Fabergé, we're a little bit tough on it because we've always committed between 10 and 11% of revenue to marketing because we see ourselves custodians and champions of a new sector or a slightly forgotten sector. So we were really championing the demand for colour as a total quite aggressively and fairly generically. Now that ad spend, we kind of direct half of it to Fabergé and half of it to Gemfields. So in reality, some of it's taking up a chunk of marketing spend that maybe we would have been absorbing ourselves anyway. So, if we took that all at a Gemfields level, because saying we would have done it anyway, its numbers would be slightly different. Plus the fact that by it himself driving the appreciation for colour, it drives more demand, which then reflects on our revenue numbers. I certainly believe Fabergé as a collective, as a whole, has helped us achieve the numbers we do. So it's difficult, it often gets a stick because on a standalone basis, but I've got no doubt it has added value. It is certainly for various other reasons, but it together with a few other things, as much as our minds are great and our people are great and everything else, something like Fabergé immediately increase your global exposure and global recognition. And that's very important. I mean, there's a lot of shareholders that I meet that I wouldn't have been interested in a very small junior gemstone company before, but with Fabergé, it opens a lot more doors and it's part of, as I said, going from a child to a teenager to an adult. So that's really where Fabergé is, and I certainly do believe as a whole it adds value and will continue to do so. In terms of Montepuez and the growth trajectory, you focus on Montepuez alone. We've brought to the market two very, very kind of positive resource updates just recently. One was Montepuez and the other is Kagem. There's two cornerstone projects to the business that both have potential to increase both in terms of volume and production and have a kickback into increased revenues, etc., etc. So both of them are there. What is our way of doing it going forward? While there's potential for a step change, so there's potential there for a certain amount of capital investment and a massive increase escalation in production, Gemfields' approach has always been slow and steady. We definitely see ourselves as custodians of the sector, and as a result, it's a question that people have been asking me for the last 6 years. Ian, okay, so where to from now? Do you suddenly ramp up growth or slow and steady? And I've always said we've got two options. As and when we feel the time is right, there's definitely potential to ramp it up very quick. Until then, slow and steady is still growth. We still have a growth trajectory and we'll continue to maintain that. Naturally, we can also look at all options. So in other words, we are looking at the potential to grow it, and that would need certain potential funding opportunities. The other one is, of course, we look at the downstream, our customers. We need to help them absorb more, plus we want to create more demand at a consumer level. So I think as a company we've done extremely well today in managing as slow and steady as possible. The only thing I always smile about is the only thing that hasn't been slow and steady is sometimes the share price. Thank goodness we're just miners and we manage that. The share price is your guys' job. It bounces all over. But slow and steady means people understand this new sector growing in. It helps analysts and investors understand where we are, and that's certainly the way we'd like to do. So for now, while we will evaluate all options, there's no, we're not going to rush out and do something massive right at this point in time. Deb, I don't know if you or Janet wanted to add to that.
Yeah, no, I think you've added.
Okay, super. Thank you.
Yeah, just a quick one. Martin Potts at FinCap. Second half costs increased quite a lot. That's not yet translated into a revenue increase, but clearly will have to if those costs are, as I understand, what to expect going forward. What's your expectation for revenue over the next year or two, given market conditions? And do you think the revenue increase will come from volume or price or both or what?
Janet, you can just talk on the cost, and then I'll talk on the other part.
Okay. In terms of the cost, I would expect a small increase, probably around 5 to 10% from where we are in terms of 2015 costs. And that's mainly going to be driven by the increase in the new projects that we've acquired in the last financial year. And then in terms of the revenue, Ian?
Yeah, so in terms of the revenue, Martin, It's going to be a little bit of both. So you can see we've had a very good year of production. We like to keep about a year's worth of production stock at Kagem. The previous year was 20 million carats, so we actually run our stock down a little bit lower. So now we've done 30. So, that's a slight factor there. Certainly we're able to sell more into the downstream market. We also do believe that there is, as I said, if you look at across the range of our product, there's still a significant gap, per quality, per price, especially when you consider the relative rarity and the very pleasing margin that the downstream industry is enjoying with our product compared to a number of others. So there certainly is potential to increase those. So I think the increased revenue will come from all of those. But the increased costs, some of them are one-offs. So some of them is like your resource statement. Your resource is a big chunky amount that you're investing for those. You don't look to do those on a regular basis, but it's certainly, when you live on and eat and sleep and breathe the mines like we do, we didn't really have to do a resource statement. A lot of that is to give the market an understanding of what we have, but it's quite a chunky amount that you don't repeat too often. So those are one-offs. In terms of the investment into Sri Lanka, Colombia, Ethiopia, etc., those would look to grow slightly, but like Montepuez, you start funding them now and they start paying for themselves slightly later down the line. So, but not the next year, but certainly at some stage generating significant more revenue than the actual costs themselves. And I think there probably are a few other miners that are able to contain costs relative to the actual output they're giving better than Gemfields, but I don't think there are too many. I think, if you think of what we're doing, say Montepuez, for example, total investment of just over 50-odd million and already a return of 120, that's pretty, kind of impressive. And if we can apply that same philosophy to Ethiopia and Colombia, I think all of our investors are going to be very happy in time. In fact, they're probably going to say, Ian, why didn't you spend a bit more, a bit sooner? But slow and steady is our approach. Okay. Any other questions in the room? If not, I'll go to the phone lines.
There are no questions on the telephone at this time, but again, please press *1.
Okay. I'm hoping there's still people dialed in, otherwise they kind of, we've answered them all in our talk. And do we ask any questions on there's emailed ones as well? No, so that's it. All right. With that, thank you all of you. Thank you once again. And last of all, thank you to my team. Incredible job. Very proud of all of you. Thank you.